Welcome to the weekly market recap. Today is Saturday, July 11th, 2026. What an absolute wild ride of a week. The tech bulls are officially running wild, dragging our benchmark SPY up by a solid 1.2% to wrap up its fourth winning week out of the last five. If you're wondering what sparked this absolute party, look no further than Wall Street's completely bottomless appetite for anything and everything related to the artificial intelligence boom. While the broader market indices like the Dow Jones Industrial Average suffered a quiet 0.5% slide, growth-focused traders were busy throwing absolute mountains of cash at semiconductor plays. We are looking at a true split-screen economy right now where tech acts like it's strapped to a vertical rocket ship while traditional cyclicals are just trying to remember where they parked their cars. Let's dive into the sectors because the performance gap this week was completely spectacular. Tech and semiconductor equipment did not just outperform, they absolutely destroyed the competition, fueled by a historic international listing on the NASDAQ that sent shockwaves through the entire trading community. On the other side of the ledger, defensive sectors, real estate investment trusts, and interest rate-sensitive consumer staples felt a major chill. Capital is aggressively rotating out of old-school safe havens and rushing straight into the infrastructure powering the next generation of computing, making it incredibly tough for traditional value managers to find their footing. Now, with all of this incredible tech euphoria floating around, you would probably assume that market sentiment is completely boiling over into dangerous territory, right? Well, think again, our trusty greed and fear index locked in at a dead center 49 this week. That lands us squarely within neutral territory. It tells us that while growth traders are aggressively buying up every single high-bandwidth memory chip in sight, the broader institutional landscape is maintaining a highly disciplined stance, keeping plenty of dry powder on the sidelines, and keeping the market beautifully balanced. The undisputed heavyweight macro story of the week belongs to SK Hynix. The South Korean semiconductor monster officially landed on the NASDAQ via a jaw-dropping American depository receipts listing under the ticker SKHY. They successfully raised an absolute mountain of cash, bringing in a massive $26.5 billion, making it one of the largest foreign listings in financial history. The market rolled out the red carpet as the shares exploded 13.1% on Friday alone, closing out at $168 after being priced at $149. Why is this a massive deal? SK Hynix controls a staggering 60% of the global high-bandwidth memory market. Without their specialized architecture, NVIDIA's top-tier AI accelerators literally cannot function. Wall Street proved this week that its hunger for AI hardware is nowhere near satisfied. Next up, the global energy grid kept macro investors on high alert all week long. Geopolitical friction flared up heavily near the critical Strait of Hormuz, instantly triggering an oil price spike early in the week and putting the entire financial world on absolute edge. Traders hate uncertainty, and when one of the planet's most vital energy transit choke points flashes red, risk management protocols take over the tape. While crude oil prices eventually eased off their weekly highs by Friday afternoon, the underlying tension served as a stark reminder that geopolitical wildcards are actively lurking in the background, fully ready to disrupt international supply chains at a moment's notice. Rounding out our macro top three, we witnessed an unprecedented political moment on Monday morning. President Donald Trump kicked off the trading week by physically ringing the stock market's opening bell directly from the Oval Office, marking a definitive first in modern financial history. This moment perfectly underscored his administration's ongoing philosophy of treating equity market performance as a direct, real-time scoreboard for his economic policies. Whether you follow the politics or not, it proved once again that Washington remains hyper-fixated on the behavior of Wall Street, ensuring that regulatory expectations and fiscal conversations stay tightly correlated with daily market moves. Let's talk about our top large-cap market movers, starting with the absolute king of the corporate jungle, Apple AAPL stock, put on an absolute clinic this week, rocketing up to brand new 52-week highs and pushing its total market capitalization to an eye-watering, mind-melting $4.64 trillion. Apple is proving to be the ultimate safe haven asset for institutional growth capital. As macro investors hunt for mega-cap ecosystems that can safely monetize integrated consumer AI software over the next decade, Apple continues to capture the lion's share of long-term capital inflows, cementing its position at the absolute top of the S&P 500 pyramid. On the complete flip side of the coin, we have VC Properties. In a week where almost everything large cap was ticking higher, VC stood out as the lonely, isolated S&P 500 stock, sliding down to touch a clean 52-week low on Thursday. This real estate investment trust has shed roughly 3.8% over the last month, triggering an intense buy-the-dip debate across trading desks. Wall Street analysts are pointing out that while the stock price is getting beaten up due to broader interest rate fatigue, the underlying business fundamentals and casino rental cash flows remain incredibly robust, making it a stellar contrarian watch. Our third trendy large cap mover of the week is Delta Air Lines. Delta stepped right up to the plate and dropped its highly anticipated corporate earnings results, giving Wall Street a crucial first look into the true health of consumer travel spending. The numbers triggered massive trading volume as institutional investors thoroughly mulled over the complex trade-offs between soaring premium travel demand and rising operational input costs. Delta's performance sent immediate ripples across the entire airline and hospitality sector, setting a highly important baseline for what we can expect as the rest of the corporate earnings season begins to roll out. Shifting gears to the wild, highly volatile world of small cap equities. Let's start with the biggest firecracker of the week, First Tracks Biotherapeutics. This microcap biotech play left jaws on the floor after exploding for a stunning 56% gain over the course of the week. In small cap land, clinical trial updates or microfloat accumulation can trigger absolute parabolic short squeezes, and Trax quickly became the top momentum trading playground for retail investors looking to catch lightning in a bottle. It was volatile, it was loud, and it showed exactly why small caps capture so much attention. Next up on the high momentum small cap radar is nLIGHT, trading under the ticker LASR. This specialized industrial laser and advanced semiconductor component manufacturer enjoyed an absolute powerhouse week, ripping higher by 27.3%. Lesser caught a massive bid as savvy traders actively looked downstream for cheaper small-cap engineering plays that supply essential subcomponents to the broader defense, aerospace, and tech hardware sectors. When mega-cap tech valuations get extended, capital quietly cascades down to specialized small-cap infrastructure operators like nLIGHT. Rounding out our small cap highlights is Bitdeer Technologies, which charged ahead with a robust 14.1% gain this week. BTDR caught fire after releasing key operational metrics and showcasing impressive scaling updates regarding their cell phone mining hash rates and computing power fleet efficiency. As small cap investors continuously hunt for pure play digital infrastructure assets that bridge the gap between heavy hardware operations and high performance computation, Bitdeer is quickly becoming a favorite vehicle for high beta growth portfolios. Pivoting over to the charts, let's plot out our map for the S&P 500 via the SPY ETF. After closing out the week strong at 750,539, the structural framework is beautifully clear. On the upside, the ultimate psychological ceiling rests firmly at the 7,600 level. If the bulls can print a clean daily close above that line, it opens up the door for a massive continuation run on the defensive side. Our immediate line in the sand sits at the 7,500 support zone. If that breaks, expect a swift retest of the major structural weekly support down near 7,400. For the tech-heavy NASDAQ 100 tracker, the QQQ closed out a spectacular week at 26,281.61. The technical blueprint here is highly defined. Immediate overhead resistance sits right at the 26,500 round number, which has acted as a short-term take-profit zone for nimble swing traders. If macro data continues to favor growth, that level will melt away easily. On the downside, if we see a healthy tech cool-off, the primary weekly support line to watch is sitting comfortably at 25,800, keeping the intermediate uptrend completely intact. Now, for the lagging child of the market, the Russell 2000 ETF known as the IWM, closing the week down at 2,977.81. Small caps are facing a tough technical test here. Overhead resistance is locked in like iron at the key 3,000 milestone level. The bulls absolutely must reclaim this zone to prove a sustainable macro breakout. Down below, support is active around the 2,950 level with critical long-term structural trendline support, waiting patiently at 2,900. If IWM drops below 2,900, the small cap bear narrative will likely gain heavy steam. Moving on to the digital asset arena, Bitcoin experienced a highly fascinating week of consolidation, hovering around the $63,962 mark. The big headline making waves across the blockchain was Galaxy Digital transferring 2,500 BTC, worth roughly $160 million, straight onto exchange wallets within a single hour on Friday. Large on-chain transfers like this typically signal impending selling pressure, keeping short-term traders on high alert. Technically, Bitcoin is coiling tightly. Crucial downside support is well established at $61,810, with an ultimate safety net down at $59,700. If the bulls can shake off the exchange inflows and breach heavy overhead resistance near $65,300, expect a violent squeeze back toward the highs. Over in the smart contract kingdom, Ethereum has been locked in a parallel phase of short-term indecision, closely mirroring Bitcoin's choppy sideways action. ETH is struggling to establish a definitive direction as retail momentum remains highly selective. From a technical perspective, Ethereum's immediate line of defense is its structural support floor at $3,400. If macro liquidity stays supportive, the bulls will attempt another charge at the overhead resistance cluster sitting right around $3,650, which needs to turn into a support floor before ETH can launch its next major leg up. As for the broader altcoin landscape, it has been a tough, fragile environment. The crypto fear and greed index has slumped back down into the 30-point area, placing the market firmly within the fear zone. This structural fragility shows that retail risk appetite is temporarily tapped out, leaving major capital concentrated solely in mega cap layer ones. Until the market sentiment index breaks out of this fear pocket, altcoins will likely continue to experience low volume drift and sporadic liquidity shakeouts. Looking back at the big picture, our closing market sentiment is defined by a fascinating split-screen reality. Institutional capital is aggressively backing secular AI hardware winners while treating the rest of the market with extreme selective discipline. The tech bull run is very much alive, but it is moving with surgical precision rather than lifting all boats. Traders who chase overextended names are getting punished, while those buying institutional accumulation zones are thriving. Heading into next week, the ultimate catalyst to watch will be the official corporate kickoff of the Q2 banking earnings season. Alongside fresh macroeconomic data prints on retail sales and manufacturing indexes, these data points will give us the ultimate answer on whether the broader economy is cooling off too fast or maintaining a healthy glide path. Keep your risk tightly managed, keep a close eye on those structural support levels, and let's see if the bulls can keep this momentum alive. That wraps up our weekly market breakdown. If you found this recap helpful and want to stay ahead of the smart money every single week, do me a huge favor, hit that like button, smash that subscribe button, and turn on notifications so you never miss an update. Safe trading out there, and I will see you in the next video.